Hello, my name is Donald Timms. I'm the owner of the Loan Loss Police. Our website is www.loanlosspolice.com. That's loanlosspolice.com. And at our website we have a free ebook you can download, and it talks about loan modifications, what they are, what they aren't, who qualifies, who doesn't qualify, and it basically just simplifies the whole loan modification process. What's happening out there today is the new loan modification companies are trying to create confusion in the market, and they're confusing homeowners as to what a loan modification is. A loan modification is very simple. I'm going to explain it in this presentation, and you can also get it in my ebook. First of all, Loan Loss Police is a nationwide loan modification company. We're licensed in all 50 states. We have agreements with departments of real estate in all 50 states. We have licensed attorneys on staff, and we've successfully completed over 300 loan modifications per month, which is probably one of the largest firms out there performing loan modifications. Now I want to talk about what a loan modification is. It's very simple. All a loan modification is a renegotiation of your loan, the terms of your loan. For instance, you may have a reduction of your payment, a reduction of your interest rate, and or a reduction of your principal balance, or all three. A typical loan modification would be when we reduce your interest rate, say from 7 or 8 or 9 or whatever it may be now, to between 2 and 5%. We rarely modify a loan with an interest rate over 5%. Typically, there 2 to 5% is the range where we modify a loan. And now we are sometimes seeing 0 to 1%. I know with Litton Financing and Litton Servicing, last week we got 2 or 3 loan modifications at 0% for 3 years. But that's an exception, not the norm. I want to talk to you very briefly about some of the scams that loan modification companies are using. And I want you to be aware of this because you don't want to fall in this trap. One of the things these loan modifications are doing is they're trying to sell your loan modification, of course. But the trick they're using is they're talking to you about principal reduction. And what they tell you is that perhaps, say you had a $500,000 mortgage, that they can reduce your principal to $200,000 or $300,000 because that's the new value of your property. Don't fall for that trap. Banks are not reducing principal very often. I'm telling you, I do this every day of my life. I know what the banks do and don't do, and they do not reduce principal very often. Occasionally, but not often, so don't fall for that trap. The only time that the bank is going to modify your loan is if the household has a hardship. And hardship is very simple. A hardship could be, if, say, for a married couple, if one of the spouses has lost a job, that's a hardship, where you have a hardship making your payments. Or let's say what's common now is when a homeowner has an adjustable rate mortgage. Say your rate was 6%, and after the 2-year adjustment period it went to 9%. That's creating a hardship for you. If at the end of the month you have very little income, we negotiate with the lender to get your interest rate back down to 6 or below, like I said, usually below 5%. So that's what a loan modification is. Now, not everyone's a candidate for a loan modification. And usually when you're not a candidate is if you have no job or no income. Because a bank will not negotiate with you or with us to lower your payment if you don't have the ability to repay your loan. So if you have lost your job and you have no income, a bank will not negotiate your loan downwards. That's another trick people are using in the loan modification industry, is they're telling homeowners that even though you don't have a job or you have no income, that they can modify your loan. That's absolutely untrue. Do not fall for that trick.
Okay, so let's go through a typical scenario. The household income is $10,000 and they have household debt of $5,000. And the mortgage is $4,000 with $1,000 in credit card debt. That's how we get the $5,000 of debt. Now, in this scenario, the debt to income ratio would be 50%, which does not represent a hardship. But let's now assume that the mortgage increases to $6,000 from $4,000. So that's going to create new debt of $7,000, which would be a new debt to income ratio of 70%. This is definitely a hardship. This is when we go to the bank and we renegotiate a new loan for a lower interest rate and lower payment to bring their debt to income ratio closer to 50%, preferably closer to 32%.
So I want to thank you for listening to me for these last few minutes. And again, my name is Donald Timms. I'm the owner of LoanLostPolice.com, www.loanlostpolice.com. And again, please go to my website and download a copy of my ebook. It's free. It's a great resource for you to read, to share with your friends, your family, or anyone who may need a loan modification, or even someone who wants to learn about loan modification. Thank you very much, and I hope to talk to you soon. Thank you.